Hi, everyone. Welcome to the tax webinar for content creators. I'm really excited to have you all here today so we can demystify taxes and hopefully make taxes a little bit less scary for you. So you can understand, what taxes are as a content creator, what type of taxes you owe, how to file taxes, learn about deductions, all that fun stuff. So hopefully, by the end of the webinar, most of your pressing questions will be answered. But definitely we'll leave open a bunch of time at the end of the webinar. So if anyone has any questions, feel free to put them in the chat. I'll be looking at the chat throughout this time to answer any questions you might have. A lot of them will be answered kind of as we go through the presentation. But as we go along, I might stop and answer some of the questions in the chat as well. So let me go ahead and share my screen with everyone, and hopefully everyone can see the screen. If you can maybe give me a thumbs up, someone in the screen or in the chat, if someone can give me a thumbs up if they can see my screen, just make sure we're all there. Okay, so I think we are good to go. Okay, so just to start out, our company, Cookie Finance, we are an accounting platform for content creators. That's all we help. I started this company a few years ago, and it came out of a necessity of family members who are content creators, and the terrible time that they had working with kind of mom and pop accountants who had no idea how they worked, didn't understand deductions or anything like that, and so started this company to really be the definitive resource for content creators on taxes, accounting, bookkeeping, all that fun stuff. And just a little bit about myself. I started Cookie Finance a few years ago, like I said, but I've been a CPA for over 12 years, worked for a bunch of different finance accounting firms, and have a bunch of kids. So that's all I'll say about me. But the point of the webinar is, how we'll kind of go throughout this is the first part is all about just getting things set up correctly from the beginning. It's called phase zero. So we're going to spend a little bit of time about what you need to do as a content creator to get the foundation right for your finances. So uh, it applies to people whether you have been an established creator for years or you're just starting out. All of this is applicable to you. So we're going to start with that. We're then going to jump into the actual taxes as a creator so you can understand all the different taxes that you are going to owe as a content creator, demystify some of the things on taxes, and then we'll get into how to lower those taxes by looking through deductions that you can get as a content creator. So let's go ahead and jump right into the phase zero, as we like to call it, the foundational phase of being a content creator and starting your own business. And really, the big thing, there's three big things that we always recommend to creators. So this is whether you're just starting out or you're an established creator. These three things apply to you, and these are three things that you need to do today. Start today to do these things. They're really simple. It shouldn't take you very long to set up these things. But the first one is getting the LLC and EIN for your business. The next one is getting a separate bank account for your business. And the third one is starting to track your financials. Now, these are simple things. They don't take a lot of time, but you would be shocked with how many people or how few people actually have these things set up. We have clients making millions a year with no LLC, no separate bank account. Their finances are just kind of everywhere. And if that sounds like you, then you're in the right place because we're going to make sure that you get that all straightened out. So, let me start by talking about why we even form an LLC, because a lot of people, they ask us that question, do I really need an LLC? And the answer is you don't need an LLC. You can operate the business as a sole proprietor. You can just do what you're doing, but we strongly encourage you to get that LLC set up. And there's three big reasons why we tell creators to set up an LLC. The first and biggest one is to protect your personal assets. So, as a creator, as a public figure, you have audience in the tens of thousands or millions, and you're saying things all day, every day. You never know when a follower or subscriber is going to, sue you for something you said or you promoted or what have you. And if you don't have an LLC and you get sued and they win that lawsuit, basically to, fulfill that judgment, the court can go after any of your personal assets. So they can go after your home, your car, your personal investments. They can go after anything you have personally to fulfill that judgment if you were to lose a lawsuit. So that's a huge risk, especially as a public figure. You want to make sure that your personal assets are protected. And how you can protect it is by getting the LLC. So if you set up the LLC, you operate your business under the LLC structure. Basically, if you were to get sued and that person won the lawsuit, basically the most they could ever go after in terms of like going after your assets are the assets of the business. And as a creator business, you don't have a ton of assets. You don't have real estate. You don't have inventory and machinery and equipment and all these things. The assets of your business are pretty light. And so there's not much they can go after. And so that's like the first big reason we tell people to get an LLC. It's not insurance, but it definitely is going to be a protection. An LLC typically costs between $150 and $250 a year to have the LLC with the state. That's pretty cheap to have that protection. The next thing, and someone did ask that, can I be an LLC in an S corp? I'll answer that in just a moment. Um, the short answer is whether you're an S corp or an LLC, you're always an LLC, but I'll answer that question in just a minute. Okay, the next big reason why we form an LLC is it provides some legitimacy in the eyes of the IRS and with brands you work with. I'm sure a lot of you are used to filling out W-9s for different brands and platforms. And without that LLC and EIN, you've just been putting your name and your social security number, and you look like you are just a beginner content creator. It looks way more legitimate when you have, NC Media LLC with your EIN and you look all nice and fancy. It just provides a little bit more legitimacy that you are actually running your business like a business. And same with the IRS. The IRS, with the content creators, probably the biggest risk you run is the IRS classifying your business as a hobby and not as a business. And basically, if the IRS ever says that your business is actually a hobby, you get zero deductions. And so what that means is that you get no write-offs. All of your expenses related to your business, you get none of them, and you pay taxes on that full amount. And why they might consider you a hobby is because you have no business, you have no LLC, you have no EIN, you have no separate bank account, all these different things. So we're trying to provide legitimacy to the business that you have because you do have a business. And finally, protecting that social security number. You don't want to be giving your social security number out on all these W-9s. Better to use that LLC and EIN. Remove that social security number so you're not, sharing that with everyone and their mom. Okay, so that is the LLC. LLC super easy to set up. You can do it on LegalZoom or Zen Business for cheap, close to nothing. It takes maybe 5 minutes to set up an LLC. Strongly recommend if you are taking your content creation business professionally and seriously, set up that LLC today as soon as you're done with the webinar. It's really easy to do. Okay, the next big thing we say is set up a separate checking account. Ideally, it's a business checking account using that LLC and EIN that we just talked about. But even if it's just another personal account, that's also fine. The idea is you have a completely separate account where all of your business income and expenses are going in and out of this separate account that are related to the business. And we'll talk about those deductions in just a second. And all of your personal is in a completely separate account. Now, why we say that it's so important is because if you mingle all of your personal business together, first of all, there is that risk with the IRS. If you get audited, that they just consider you a hobby because they're like, hey, you're treating this like a hobby. Like everything's just mixed in with your personal. So like that's one part of it. But another big part of it is we want to make it easier for you to track your deductions, track your income, and make sure you are getting every deduction possible. So the best thing you can do after you do that LLC and EIN, get that separate bank account and start putting all of your income from these platforms and partnerships and brands, have those deposits straight into that business checking account. And ideally, you also have all of your expenses related to the business coming out of that same account as well. Now, some of you might have a credit card. You like to use credit cards, and that's great. You don't necessarily have to get a whole separate credit card, although you can. One thing that you can do is if you have multiple credit cards, take one of your existing credit cards, pay off the balance or whatever it might be, and say, do you want this credit card is now just going to be used for business? That way you have a completely separate checking account and credit card tied to the business. In terms of bank accounts that we like, Chase, Wells Fargo, Capital One, those are probably the most friendly banks to content creators, especially Chase. That's probably like our number one preferred. We really like them. A lot of our clients use them. So strongly recommend getting one of these three banks. If you want just an online only bank, you don't need to worry about like going into a physical branch. Mercury is a great bank as well. You could literally sign up with Mercury today after you get your LLC and EIN. You could go online to Mercury, sign up for a bank account right now, and you're done. So those are kind of the four main banks that we recommend. Chase, Wells Fargo, Capital One are good big banks with branches. If you don't need a branch, you want to just do it all online, Mercury is a great option. Um, One person asked if PayPal is okay. Yes, PayPal is perfectly fine, but that is not a bank. That is a payment processing platform. So a lot of our clients use PayPal. I know if you're on TikTok, probably a lot of you use PayPal, or if you're paying people, you still need that separate checking account though as well. So PayPal is great, but you still do need that separate bank account. Banks that you should avoid. Thank you for asking that question. The only banks that we really say you should avoid are kind of local credit unions. And it kills me to say that. I always love supporting local businesses. But when it comes to local credit unions, a lot of them are a little bit old school on how they do things. They might flag your account. We've had clients who are working with small credit unions. Their accounts were flagged for fraud because they saw all these payments coming in and expenses that looked a little bit weird compared to like their normal clientele. So we've had clients whose accounts were flagged as fraudulent. We've had clients who the bank just said like, "Hey, like we can't service this type of account." They've had to get off. They've kicked them off the account, the bank. The smaller banks, they sometimes have a really hard time connecting with like PayPal or QuickBooks or some other online platform. So uh, we really like to stick kind of like with these bigger banks or Mercury is what we say. And you can always use your local credit union for loans for your home and cars and things like that. But when it comes for the business, we say use one of these more established ones. Okay, so one thing if or the next big thing after we get the LLC, the EIN, we get that separate bank account, is getting your income expenses tracked. We recommend on a monthly basis to just go into your business account, pull all the different income, and then pull all the different expenses, and start tracking that on a monthly basis, all the income and expenses. So that way, one, you're not missing deductions, and two, so it makes taxes at the end of the year way, way easier for you. We have this income and expense tracker right here. If you're able to take a link to that QR code, that will take you to an income and expense tracker that you can download for free. To if you want to kind of do it yourself with tracking your income and expenses. But this is where having that separate bank account and credit card is going to be hugely beneficial. Because if all of your business is in a separate account, it's going to be much easier for you to just go into that one account or those two accounts every month, pull the different income and expenses, put them into that Excel spreadsheet, and track that throughout the year. It's going to avoid you at the end of the year going through thousands of transactions trying to pick out, like, "Oh, wait, was this Chick-fil-A? Was this actually business or personal? I can't remember." Do you want? I don't want to get arrested by the IRS. I'm just going to say it's personal. Oh, this trip to Best Buy. Oh, shoot, I'm pretty sure this is when I bought this. I can't remember. Like, it's going to save you a lot of heartache if you just on a monthly basis go through your income and expenses and start tracking that. Um, One thing we do recommend if you are going to do a DIY option is don't download QuickBooks or any of these other accounting softwares. It seems like a good option, but honestly, if you're not used to accounting, if you're not used to bookkeeping, it's really easy to mess it up. We've had a lot of clients who downloaded QuickBooks, they upload all their stuff, they started using QuickBooks, trying to like figure it out on their own, and they've completely screwed everything up. They do their tax return, it's all wrong because like they miscategorize things and just if you're in DIY, I say just stick with Excel and make it simple. Um, but one thing we do say is, once you get past a certain point, once you're making more than like 60, $75,000 a year from content creation, it's going to make sense to free up your time, make sure you're getting all those deductions, make sure you have always a good pulse on your business, to hire some type of professional to help you with that bookkeeping on a regular basis, just to kind of take that off your plate. So uh, those are the foundational things. Get that LLC EIN, get that bank account, and start tracking your income expenses. If you do those three things, you're going to be ahead of like 95% of the creators out there. Like I said, we have clients who are making a million plus a year who don't even have those things. So like you're gonna be in good hands if like you can at least get those things done. Okay. Um, let's talk. Someone asked about business meals deductions. We're gonna go through all of that in just a minute. So we'll get to deductions in like 10 minutes from now. First, we're gonna focus on the taxes, and we'll get to the good stuff with deductions. Okay, taxes. We're going to keep this very approachable, a little bit higher level, just so you understand the taxes that you are owed and things like that. We're not going to go into the nitty gritty of tax forms or anything like that, just so you understand the taxes that you are going to owe as a content creator. So, at a high level, what we tell people is, and this is a big misconception, no matter how much money you earn from content creation, you have to report that on your tax return. There is a big misconception out there, and it's all over TikTok. It's, hey, if you make less than $5,000 from content creation, you don't need to report that on your tax return. Or, if you earn less than $600, you don't need to report that. There's all different types of amounts out there, and all that is completely wrong. No matter how much money you make from your content creation, even if it's $5, you need to report that on your tax return. So I just want to get that out right away. Yeah, someone just said, I thought it was only if you made more than 600. No, it's any amount you need to report that on your tax return. So especially during tax time, you are going to be getting a bunch of different tax forms. The big one I want to focus on is the 1099 because this is probably one of the biggest questions we get from creators, especially during tax time, are 1099s. So when you work with a platform, TikTok, YouTube, or an agency or a brand itself, and you make more than $600 with that platform or agency or company, they are supposed to send you at the end of the year a form called a 1099. And what that 1099 is it's just showing you how much that company paid you throughout the year. So if you earned $10,000 from TikTok throughout the year, at the end of the year, TikTok should send you a 1099 in the mail. You can also probably access it online, but they'll send it to you in the mail, and you'll get it, and it'll say, "Hey, Susie Smith, on TikTok, we paid you $10,000." Now, I say that they're supposed to send those out. Not all companies do send them out. So we've had a lot of clients where they're like, "Hey, I was working with, I don't know, Home Depot, and Home Depot never sent me a 1099. What do I do?" And the answer is you still have to report that income. Even though Home Depot did not send you a 1099, you still have to report that income. And usually it's kind of a waste to try to like hound the companies to send you a 1099. They'll probably just like shrug their shoulders and be like, tough. So it's good to get those 1099s, but they're not required, and some companies just won't do them. But regardless, whether you get a 1099 or not, you have to report that income on your tax returns. Now, with 1099s, it is really important that when you start getting those 1099s in January and February at the beginning of the year, it's really important that you check your own records against what the form says. That's why it's important throughout the year to be tracking those income and expenses, because when TikTok sends you that 1099, you want to take that 1099, compare it to what's in your records, and make sure they line up. And if they don't, you need to get a hold of that company right away, because if they say you earned 20,000 but you actually only earned 10,000, well, that 20,000 is getting reported to the IRS, and when you submit that tax return and you only showed 10,000, the IRS is going to be like, it's supposed to be 20,000, and we're automatically going to adjust your tax return, and you're going to owe us more money. So make sure those 1099s are correct. A couple people asked the question, um, if they don't send one, do I self-report it? The answer is yes. No matter what, even if it's $5, $100, $1,000, whether they send you 1099 or not, you have to report that income on your tax return. I'm not going to go through these other tax forms because I want to get into what taxes you are going to owe as a business owner. So this is whether you have an LLC, a sole proprietor, an S-Corp, whatever it might be. These are the taxes that you are going to have to owe as a content creator. The first big one, oh, actually, before I get to the taxes, let me tell you what you're being taxed on, because that's a really important thing to understand. So let's say this last year you earned $100,000 from content creation and you had $40,000 of deductible expenses, which we'll go through in just a minute. Your net income would be $60,000. Now you are being taxed on this 60,000. Okay, so that's what the IRS is basing your taxes on, is this net number right here. You take your income from the business, take out all of your deductions, and that net number, that is what you are being taxed on. So you're being taxed on this 60,000. Okay, now what taxes do you owe? Well, the first big one that you can't avoid, unless you want to go to prison, is the federal income taxes. Depending on your tax bracket, how much you earned from your content creation, how much you earned from your W-2 job or your spouse, those taxes can be anywhere from 10 to 35, 37%. So that's going to be the big one that you owe. Once again, it's hard to pinpoint exactly how much you'd owe because it kind of depends on your tax bracket, but anywhere from 10 to 35% is probably what you're going to owe in federal income taxes. Basically, the only way to avoid paying those are finding every single deduction that you can possibly find. That's the best way to lower those taxes. A lot of people ask us, what's the magic bullet so I don't have to pay taxes? The answer is there is no magic bullet. It's finding as many deductions as possible and being smart with some taxes down here, which we'll talk about in a minute. The next big bucket is going to be state income taxes. Depending on the state you're in, if you're in a state like Nevada, Florida, Texas, New Hampshire, you have no state income taxes. So that's fantastic for you. And it can go all the way up to 8, 10, 12% if you're in a place like California or New York with really, really high income taxes. But most states is kind of around, call it 4 to 5%. So it's another really big amount that you'll owe in taxes are state income taxes. Now, the final one. This is the one that gets creators every single time. It's self-employment taxes. Most people are not prepared and ready for this tax when it hits. So if you did your taxes for the first time as a creator and you're like, wow, those taxes were way higher than I was expecting, most likely it's because of the self-employment taxes. That is Social Security and Medicare, and it's 15.3% on that net income. So it can be a huge, huge hit. That 15.3% is on top of the federal income taxes and your state income taxes. So it can be a ton. Now, I'll talk to you a little bit about self-employment taxes because this could be really confusing. If you have worked a normal W-2 job, uh, you probably saw on your paycheck, out of every paycheck, they were taking out Social Security and Medicare. Maybe you did or didn't know this, like how that percent was calculated, but it was 7.65%. So out of every paycheck, they took out 7.65% and paid that towards your Social Security and Medicare. Now, what most people don't realize is that the employer was also paying 7.65% of everything you made and paying that to Social Security and Medicare as well. So when you combine both of those 7.65s together, you get 15.3%. So when you are self-employed, like you are as a content creator, all the income you earn from that self-employment, you are both the employee and the employer. So you have to pay both half of those taxes. So you have to pay the full 15.3%. It is killer. That applies whether you're a content creator, a contractor, anything where you're not getting a W-2 wage, that 15.3% applies to that net income. So please take that into consideration. We typically say if you set aside about 25% of everything you make, I'm talking about the gross number up here. So if you earned $100,000, if you set aside 25,000, 25% of everything you make for taxes, you should be in a pretty good spot to cover all of these taxes up here. So that's kind of the rule of thumb. 25% of everything you make, set that aside into a separate savings account. Don't touch it. Um, and you should be more or less good to cover the taxes for the year. Okay, let me just look in the chat, see if there's any questions. Um, And okay, so some talked about, they've been setting aside 30%. That's fine too. 25 to 30%. If you're at 30%, that's totally okay. Just don't go below 25% just to make sure you fully cover your taxes. Okay, the one of the final things I want to talk about with taxes are quarterly payments. Another huge question. Do you need to make quarterly estimated tax payments? But before I get to that, let me ask or explain why we do quarterly estimated payments. So back to the W-2 example, when you're working just a normal W-2 job, or if you have a normal job right now, out of every paycheck, your employer is taking money out of every paycheck, and they are, submitting taxes on your behalf to the IRS, the state, Social Security, Medicare. So you get paid $1,000. They take some of that money out for federal taxes, state taxes, Social Security, Medicare. They're doing that every single paycheck, paying on your behalf. And then at the end of the year, you are then truing it up when you do your tax return. And sometimes you get a refund, sometimes you don't, and so on. Well, when you're a content creator, when you're a business owner on your own, no one's paying those taxes for you. No one's withholding taxes and paying on your behalf. It'd be great, but no one's doing that for you. So you are responsible for making those payments to the IRS. Now, you can just pay all your taxes at the end of the year when you file your tax return. You can definitely do that. But the IRS, they say, hey, Sarah, that's great that you want to do that, but we want our money and we want our money right now. And so we want you to make payments throughout the year towards that potential tax bill. And if you don't, we are going to charge you 8% interest for every quarter that you are not making those payments. And on top of that, we're also going to hit you with some different penalties and fines as well. So it could actually creep up higher than 8%. So it's a huge fee. We've had clients hit with, 500, 1,000, thousands of dollars worth of interest and penalties because they didn't make those estimated payments. So make those payments every single quarter. If you don't know how much you should, be paying, uh, it can be really hard to figure it out on your own. Work with a tax professional to kind of help you figure that out. If nothing else, take that 25% you set aside and submit that as a quarterly payment. That's a good proxy, and then you can always figure it out at the end of the year. or work with a tax professional to kind of help you figure that out. But um, you know, someone asked in the chat, does this mean we basically are doing taxes 4 times a year? No, you don't submit anything when you make those payments. You don't submit any tax returns. You don't submit any forms. You just send that payment to the IRS. You say, this is for quarter 1 of, say, 2025. And the IRS says, thanks, noted, and we'll keep track of that. But yes, you should be recalculating that every single quarter to make sure that you're paying as much as you need to pay in quarterly taxes. It stinks. But to answer the other question, yes, it can all be done online. So feel free to make those payments online. It's really easy. Just go to your IRS online account and you can make the payment directly through there. Okay, on to deductions. So taxes, they suck. We definitely don't want to pay any more in taxes than we need to. And so the next big question is, well, how do I reduce my taxes? And the answer is finding deductions and making sure you're claiming deductions on things that you're already spending money on that relate to your business. Now, before I proceed, I'm going to leave this up for just a minute. The content creator deduction cheat sheet. You're welcome to go to the cheat sheet. We have this really nice 2-page sheet that goes a little bit more in depth on different deductions you can be taking as a creator. So feel free to download this, get that cheat sheet. That way you kind of have that in your back pocket when you're trying to understand whether or not something is deductible or not. Okay, so let's talk about what are deductions. Deductions, by the way, you're probably going to hear me use the word deduction, write off, business expense. They're all the same thing. Um, and basically, a deduction is just a legitimate business expense that offsets your income. That's it. Um, and how I want you to think about deductions, because it can be really easy to get tripped up in the nuances of deductions of like, oh man, I went to Home Goods and I bought this thing. I'm trying to understand, like, is this like really deductible or not? And it can be really easy to get caught up in the weeds of like what is and isn't deductible. So what I want to provide you with is a framework of how to think about your deductions at a high level. And then you can use that framework for whenever you're thinking about, is this business or personal? And what I want you to think about is to think about your phone. So um, let's say you have an Apple. Apple spent hundreds of millions of dollars developing the phone that you have. They spent money on research, development, on marketing, sales, packaging, shipping. They spent hundreds of millions of dollars developing that iPhone. And the reason they spent all that money is because they know they can mark it up at a higher price and sell it to you for a profit. And so what we call that is the cost of goods sold. All of those expenses that go into selling a product are called the cost of goods sold. It's the cost to sell your product. Now, you as a creator also have a product that you are selling. The product you are selling is your brand, your engagement, your trust, your image. That is what you are selling. So when Home Depot comes to you and they say, hey, we're going to give you $15,000 for a sponsored video. They're giving you that $15,000 because you have a community of 500,000 people on YouTube who know, trust you. They are engaged with your videos. They're an active audience. And so Home Depot is paying you for access to that community that you have cultivated. And so that is what you are selling. So anything, any expense that is building your brand, your audience, that engagement, that trust, those are going to be the things that are going to be deductible. So we're going to talk about deductions at a high level, kind of keep it broad, but use that as the lens of, is this helping my business grow? And your business is your audience, your community. Is it helping that grow and become more engaged? If the answer is yes, then it's deductible. If it's no, then it's probably personal. So use that as the framework. Okay. Let's talk about deductions that all of you can be taking. The first one, technology subscriptions. So if you're using Adobe, Epidemic Sound, Spotify, any type of editing software or anything like that, all of those apps are going to be deductible. Apple Storage, Google Storage, things like that. All of those things are going to be deductible. If you have things like Linktree or you have your own website or whatever it might be, all of those online tools and subscriptions are going to be deductible. We also say, make sure you're deducting your Netflix and Max subscription and Apple Plus subscription. And the reason why we are totally okay deducting, those TV services is because as a creator, you have to be very much in tune with the latest trends going on, right? It's no different than a normal business getting a subscription to the Wall Street Journal or the New York Times. They can deduct that because it's part of their business. It helps them stay current on current events. It's the same thing with these TV subscriptions. You have to be very much in the know on current trends, and the way to do that is with these subscriptions. So make sure you're deducting those as well. Okay. And one question was, can I deduct purchases? You uh, oh, purchases to review and stream. I'll get to that in a second. Um, okay, cell phone internet. Yes, you can definitely deduct your monthly cell phone bill, your home internet. Some people, if you are part of a family plan and you Venmo your mom each month, 125 bucks, like, that's deductible as well, right? So any of your monthly cell phone bill, home internet, 100% deductible. Equipment, if you buy a new computer, camera, sound equipment, video equipment, lighting, any of that type of stuff, all that's going to be deductible. And same with, um, any, materials or decorations or anything for your home office. So I know a lot of you will use your like a dedicated space in your home to create videos. All the expenses as part of that home office are going to be deductible. Even if that home office is your kitchen and you have to do like a new backsplash or whatever, like for food creators, you can definitely deduct that as well. Health insurance, if you purchase health insurance on your own, so you don't get it from your work or your spouse's work, but you went out and bought your own health insurance, that health insurance is deductible. And health insurance is freaking expensive. So make sure you're giving yourself that deduction. It's a huge deduction. Make sure you're giving yourself that deduction. Okay. Marketing expenses. I'm sure a lot of you might be working with agencies who might be taking 15, 20%. Make sure you're deducting that. If you run ads through Meta or whatever it might be, make sure you're deducting those as well. Professional services, like we talked about at the very beginning, forming an LLC. So the cost to form your LLC is going to be deductible. If you work with an accounting professional like Cookie Finance or your local CPA, all of that will be deductible as well. Same with if you hire any contractors to help you, edit, shoot your videos or anything like that, virtual assistants, those are going to be deductible. Home office. Like I said, I'm sure a lot of you use a portion of your home as your home office. And so you are able to write off a portion of your rent and mortgage, as well as your utilities that are part of your home office. It's a little more nuanced. I don't want to get too deep in the weeds on that, but definitely when your tax professional is working on your tax return, make sure they're giving you the home office deduction. Um, Personal items, this one is a little bit tricky. But one thing we say, if you are camera facing, definitely hair, makeup, nails, that's deductible. That's easy, no problem there. Botox is unfortunately not deductible. That's a big question we get. Botox and plastic surgery are not deductible. It's one of those few things in the tax code that is pretty cut and dry that those things are not deductible. Clothing is a little bit tricky. So I'll kind of give you two different scenarios. One is a fashion creator who makes money off of affiliate links with Amazon and LTK. Um, you know, that person, absolutely, they can run off all the clothing that they purchase that then have affiliate links associated with them. Not a problem at all. All the clothing they buy, even if they use it for personal use, but they're buying that clothing, they're featuring it on their content. They then have links to that, affiliate links to it. That's all deductible, no problem at all. Once again, even if it's used for personal use. Where it gets a little bit trickier is if you are not a fashion creator, and you don't like make money off affiliate links with clothing. What we say is if you buy a piece of clothing that is for a if you buy a piece of clothing that's for a piece of content, let's say you buy a new outfit and it's kind of specifically for a shoot, or a piece of content, absolutely you can deduct that. But if it's like you're buying new PJs and you're not featuring that anywhere, it's like not a part of your content, keep that personal, keep that a little bit cleaner. Um, and just looking at the chat, make sure, yeah, someone asked about what about clothes I wear in videos. Once again, if you buy that clothing for that video, totally fine to deduct it. But if it's just like part of like your normal street use, probably be safe and don't deduct it. Someone asked about games they purchase. Absolutely. If you're a video game content creator, um, anything you purchase that's building your content, that's definitely going to be deductible. Video games, we have a lot of video game content creators who make hundreds of thousands of dollars a year. They can't make that money without buying that content or without buying those video games. So make sure that you deduct that as well. Okay, potential deductions. These are things that you might be able to deduct and just use your best judgment for some of these things. The first one is travel. Now, easy travel deductions are going to be if you're meeting up with other creators for a collab or for branded content or for a conference. That's easy. 100% of the travel, the airfare, Airbnb, hotel, Uber, meals, all of that is deductible. No problem at all. Now, if you are just taking a vacation, let's say I'll use family. I have 4 kids, so let's say you're going to Disney and you want to deduct your Disney trip with you and the family. What we tell people is just make sure that travel that you're producing significant content around that travel. So for instance, if you want to write off that Disney trip, an example might be before the trip, you buy a bunch of things from Amazon, you have affiliate links to all those things, you're creating videos and posts about like, hey, these are like the top 5 travel hacks for traveling with 4 kids to Disney, and look at these amazing things I bought from Amazon, and links in my, in my in the video or whatever. That's great. You're producing a bunch of content, you're producing a bunch of reviews beforehand, getting ready for the travel. During the actual trip to Disney, you're posting a bunch of content there. There's just a bunch of content that you're building around this trip. Some of it is linked with affiliate links. It might be for brands, whatever it might be. But just something where you can point back to if you were audited, right? You can go back and say, look, here's all the content I produced. Look at all the new subscribers I got. Look at all the likes and comments and shares and all these different things I got out of this trip, right? That was building my audience. I was building my content. So all of that can definitely be deductible. Now, if you are going on a trip to Disney and you take like one picture of you and the fam and you're like, hey, having so much fun at Disney, like post it and like that's it, probably not deductible. Once again, you want to build a lot of content around it. Um, and someone said, can I pay my kids for being in the vacation videos? If we have time, I'll talk about paying kids. Always a little bit tricky. You definitely can pay your kids. I wouldn't pay them for being in the vacation videos per se, but you definitely write off their portion of the trip. Okay, meals. Definitely take advantage of meals if you are, you know, getting meals so you can work more. You're gonna DoorDash, Uber Eats, things like that, because like you're working so hard and like you're getting these meals to like save time and everything else. Deduct it. If you're going out and you're discussing content with your friends and family, significant other, It's a business meal. Definitely take advantage of the meals. Auto, once again, this is sort of like a home office deduction. There's a lot of nuance here that we don't really have time for, but definitely talk with your accountant about it. If you use your car more than 50% for business, you can write off a portion of your vehicle. And even if you don't use it more than 50% for business, you can still deduct the mileage you use as part of your business. So if you're traveling a bunch around town to and from different shoots and everything else, you can deduct those mileage as part of your business. So let me just go back to the chat, make sure I didn't miss anything. Okay, I'll talk about the kids because I think that's been now a couple of questions on that. Um, you are technically allowed to pay your kids, and that is tax deductible. But just be careful. There's a couple of things that are, I'll call them red flags to the IRS, or at least orange flags to the IRS. One is auto. Don't get too crazy on the auto deduction. I had one client that was like, "Hey, I saw on TikTok that if I buy like a brand new Porsche and I put my logo on it, I can write it off 100% for marketing." Like I saw on TikTok, and this guy does it all the time. I'm like, I've seen that TikTok, and that's wrong. It's called no. And sure enough, he went out and bought a brand new Porsche, spent over $200,000 on a brand new car, slapped his logo on it, is like, boom, marketing expense, want to write off 100%. I'm like, that's not how it works. It's also a huge, huge red flag to the IRS. Um, so definitely be careful when you're taking the auto deduction. I'm not saying you can't do it. You definitely should take advantage of it, but don't go crazy. Don't try to claim that 100% of your vehicle is business use when it's your only car and you clearly use it for going to the grocery store and everything else. So just be careful, is what I'm saying with auto. Um, the other one is paying kids. It's definitely a red flag, so don't abuse it. The IRS wants to make sure that you're paying your kids market rates and that your kids are actually like doing work. So if you ever are audited, just make sure that you can back up what you're paying your kids. A lot of people say like, oh, like my kids are models. Just make sure that you actually have like backup for that, right? Like what is market rate for paying a kid model? How much were your kids in the videos or in whatever the content? Just make sure you can actually back it up. Totally fine to pay your kids. A lot of creators do. Just be smart about it. Don't pay them outrageous amounts of money because it's an easy way to avoid taxes. The IRS knows it, and so they're definitely going to flag it when they see that on the tax return. Um, okay, and you don't need to do payroll. You can just pay them as like a contractor, basically. What about cars over a certain weight? Back on the car thing. It doesn't matter how much your car weighs, you can deduct your car, but you do get a bigger deduction for cars that weigh over 6,000 pounds or a larger potential deduction. So a lot of people think they have to buy a car that's more than 6,000 pounds. That's not true. It can be below 6,000. You just get a bigger deduction for cars over 6,000 pounds, which pretty much every single SUV is above 6,000 pounds these days. Okay, a couple of FAQs. I know we're kind of getting to the end of the webinar, but a couple of quick FAQs. Does my company slash LLC pay taxes? And the answer is no. Whether you're an LLC or an S Corp, the company does not pay taxes. The only person who pays taxes is you individually. An LLC and an S Corp is what's called a pass-through entity. In other words, all of the income and expenses from the business, from your LLC, your sole proprietor, your S Corp, they flow from your tax return to you personally, and then you pay taxes on it. So um, you're not going to owe any more taxes by being an LLC or S Corp. It's the same amount of taxes. You also don't get any more deductions. It's just a better structure to have. This question of I made less than $5,000 or $600, do I still need to report it? The answer is yes. We talked a lot about that earlier. And the final thing is, should I be an LLC or S Corp? This is probably one of the more common questions we get. We don't have time to go through like what an S Corp is. Definitely feel free to book a time with our team and we can like walk you through that. But at a high level, if you are on track to make more than $100,000 this year, it probably makes sense for you to become an S corp. An S corp essentially helps you avoid paying half of those self-employment taxes we talked about earlier. Um, just to go back a little bit, we talked about the self-employment tax of 15.3%. Basically, the S corp allows you to avoid essentially half of those taxes, and it can be huge savings. So, um, if you're making over $100,000 a year, you can easily save five, 10, $15,000 in taxes by being an S corp. So if you're in that range, definitely talk with a tax professional. It's probably too complicated to do on your own. You don't really want to do that on your own. You should work with a professional at that point. Um, Okay, someone said, "Oh shoot, I need to be an S corp." I think. Once again, if you think you should, or you don't quite know, or really any questions you have from the webinar, I'll answer. I'll answer more questions in just a minute. But if you have any questions, I put a link at the very top with a link that you can book a free consultation with our team. Just go to that link, click on the meeting, find a time that works best for you, set up time with our team. It's completely free. We're not going to hound you to sign up with us or anything like that. But we'd be more than happy to walk you through any question more specific to you. I know as a webinar, you're probably not going to feel comfortable like putting personal information. So if you have like a special situation of like, ooh, I think I might should become an S corp, or I have like this weird tax situation, definitely follow the link, chat with our team, set up a time, and we'd be happy to chat with you. But let me go to the questions and just make sure if anyone has any additional questions they would like me to go through. I can definitely answer any other questions. So if you have any questions, last minute questions, go ahead and put that in the link. And while we're waiting for that, let me just make sure I didn't miss anything on here. I think, oh, yeah, this is actually a good question. Someone asked earlier, I meant to get to this one a little bit earlier. There's that question of, you know, I live in California, so I'm going to form a Wyoming LLC. Wyoming has no income taxes. I'm going to form a Wyoming LLC. That way I can avoid paying taxes. That's not how it works. It doesn't matter where you form your LLC, you owe taxes in the state that you live in. So if you live in California, yes, you can set up an LLC in Wyoming. That's fine. It doesn't help you at all. Yes, Wyoming has no income taxes, but that doesn't affect you because, like I said just a minute ago, when we're talking about does my LLC pay taxes, it doesn't. So it doesn't matter what state your LLC is in. Ultimately, all that income and expenses flows to your personal tax return in whichever state you're living in. That is where you pay taxes. So there's no tax benefit to setting up your LLC in a state with no income taxes. Please don't do that. In fact, it can actually hurt you because if you're operating in a state without the LLC, you can actually lose all the protections of having the LLC. So don't do that. A couple of final questions. We talked about kids on payroll. Um, Someone said that their friend uses us and raves about us. Really appreciate that. Thank you so much. Oh, do I need to pay taxes on gifts? Great question. The answer is it depends. Now, a lot of you get PR packages, you get gifts or whatever it might be from different companies. Let me tell you two different situations because they vary on how much you owe in taxes. The first one, let's say you are working on TikTok Shop and you get sent a ton of different product to review, and you get that product from the company, and then you're supposed to review it, whatever. Or let's say a company comes to you and they say, "Hey, we're going to gift you a 3-night stay at our hotel, but in exchange, we want you to produce X amount of content. We want you to post, 2 videos, one, whatever. Like, we expect you to do this in exchange for this gift that we're giving you." In the eyes of the IRS, that is considered a barter transaction. Essentially, a company is giving you something but in exchange, they are requiring you to do something in return for them. Okay, so it's a barter. Cash is not exchanging hands, but services and goods are exchanging hands. So if you have something like that, technically, um, the value of that gift um, is taxable, and you're supposed to report it. Now, if it's below $500, you don't need to worry about that. That's kind of immaterial. If you get, we have some creators who do like beauty, and they get sent, just dozens and dozens and hundreds of like beauty product throughout the year. Each one is worth like you know, uh, 15, 20, 30, 40, $50. Like you don't need to report those little ones. Like that is fine. You can exclude that. The one that you need to worry about are like the bigger ones, like a hotel stay, vacation, a new refrigerator, a new whatever, right? Like something that's in the thousands of dollars. Technically, you are supposed to report the fair value of that item on your tax return if there is some agreement of like exchange of services. Now, the other situation, let's say a company just sends you a PR box. One of our clients, food creator, was sent like a big box of Feastables, Mr. Beast's candy bar. His team sent her like just dozens of candy bars, and they're like, "Hey, we hope you enjoy these chocolate bars." Wink, wink. Clearly hoping that to her hundreds of thousands of followers, that she would bake something with Feastables, she would review it, she'd put it as part of her content, and they'd get that free publicity or free-ish. Those type of gifts, you do not need to report that as income. You do not, they did not. There's no contract. There's no agreement between you and that brand. They just send it to you as a kindness of their heart. You do not need to report that. Um, so those are the two situations that you may or may not have to pay taxes on. But once again, you should really only worry about like the big ticket items that are like in the thousands of dollars. If it's little things below $500, don't worry about it. The IRS is not going to worry about it, and you can kind of just move on. Okay, well, I think those were all the questions. Really appreciate everyone taking the time to chat with us this morning. Thank you for all those questions. Those are amazing questions. Once again, there's a link up top uh, where you can go to set up a free meeting with us, and team would be more than happy to sit down with you for 30 minutes and go deep into your taxes and any questions you might have. And you can always reach out to me. Feel free to go to our website. We have lots of good free resources on there with trackers and blog posts and other things. But thank you all for your time, and hopefully we will be talking with you soon.